The internet spent 3 days roasting a pair of glasses. Meanwhile, the company just posted its first ever GAAP profit. It generates $609 million in trailing free cash flow, and it has $500 million in cost cuts that aren't even in the numbers yet. This is not a dying app. This is a cash machine, and the market just handed you a discount because it didn't like the look of a pair of glasses. This is why I go to the numbers first. And today we're going to let the numbers do the talking. Here's exactly what I'm doing with my money and why I think this is one of the best opportunities I've seen in 2026. 6 things to cover. What actually happened on June 16th? The quarterly march to profitability, the chart most people haven't seen. The $500 million catalyst that's not in the numbers yet. The subscription business that just crossed $1 billion annualized. The real bear case, steelmanned, not dismissed. And the options play I'm watching right now. But before we get into the financials, I need to show you why the market's reaction on June 16th tells you more about the opportunity than it does about the company. On June 16th, Snap unveiled the specs. AR glasses, price $2,195, features AR displays, AI assistance, hand tracking, gaming, and navigation. CEO Evan Spiegel called it a totally new category of computing. The internet's reaction was immediate. Ugly, too expensive, nobody asked for this. The stock dropped 10% in one day, and most retail investors looked at that chart and said, "See, I told you Snap was dying." But here's the thing most people miss. In 2007, if you showed someone the first iPhone prototype, they'd say, "It doesn't have a keyboard. This thing is going to fail." The tech was right, the form factor was unfinished. That is exactly where Snap specs are today, because the underlying platform is already there. 9 billion daily AR interactions, 400,000 developers, 4 million lenses built, 75% of Snapchatters engage with AR every single day. The technology is off the charts, and I think it could very well be the future with AI integration. The technology means more than the looks right now. The market sold the look. I'm looking at what's under the hood. Now let me show you the chart that changes everything. Every quarter, they get closer and closer to profitability. Q4 2024, operating loss of $26.9 million. Adjusted EBITDA, $276 million. Q1 2025, seasonal pullback, operating loss of $193 million. EBITDA at $108 million. Normal seasonal pattern, Q2 2025. This is the trough. Operating loss of $259 million. EBITDA drops to $41 million. This is where bears say told you, but watch what happens next. Q3 2025, loss narrows to $128 million. EBITDA rebounds to $182 million. Q4 2025, operating income positive $49.7 million. That is Snap's first GAAP profit ever. In a company that has been public since 2017, Q1 2026 shows a $74 million operating loss. Seasonal pullback again, but adjusted EBITDA, $233 million. Up 115% year over year. Think of it like running a marathon. For years, Snap was sprinting the first mile on gross spending and hitting the wall. Now they've changed pace. Every quarter, they're running faster with less effort. Q4 2025 was the first time they crossed the finish line. And the most important thing about that finish line, it's about to get dramatically easier to cross again because of a $500 million catalyst that isn't in these numbers yet. On April 15th, 2026, Snap cut 1,000 employees, 16% of the entire workforce. 300 open roles closed on top of that. The market's reaction, Snap is struggling. My reaction, $500 million in annual savings is coming, and it's not in Q1's numbers. Q2 will have restructuring charges between $95 and $130 million. One-time cost, they'll show up and look ugly. But Q3 and Q4, that's when the actual savings land. That's when gross margins target 60% plus, up from 57% in Q1. The CFO's exact words on the Q1 call. The path to sustained GAAP profitability is now calculable rather than theoretical. Here's another piece most people don't talk about. 40% of all new code at Snap is now AI generated. That's why they could cut 16% of their workforce and still accelerate product development. Activist investor Irenic Capital owns 2.5% of the company. They push for exactly this kind of cost discipline. Their valuation of Snap, if the cost structure is executed properly, is $26.37 per share. The stock is at $4.71. Either Irenic is wildly wrong or the market hasn't caught up yet. and the board's actions make their view clear. They authorized a $500 million share buyback at these prices. That is management saying, we believe this stock is worth more than the market thinks. If you're finding this breakdown useful, hit subscribe. I break these down every single week. Now let's talk about the part of this story that nobody in the finance community seems to be covering. Snapchat Plus, their paid subscription tier, has 25 million subscribers, growing 71% year over year, generating over $1 billion annualized in non-advertising revenue. Here's the analogy that clicked for me. Advertising revenue is like tips at a restaurant. Some nights you kill it, some nights you get $5 on a $100 bill. It depends on the economy, the season, the advertisers. Subscriptions are like a salary, same amount every month. You can plan your business around it. Snap is moving from a tip-dependent model to a salary model. And that $1 billion annual salary is growing 87% year over year. Q1 2026 subscription and other revenue came in at $285 million. Annualized run rate $1.14 billion. Total Q1 2026 revenue $1.529 billion, up 12% year over year. That beat the top of their guidance range. Revenue is growing, subscriptions are growing. Free cash flow is at $609 million trailing. But before I talk about the play, I want to spend 60 seconds being completely honest with you about the risks, because there are real ones. North America daily active users, 92 million, down 7% year over year. This is the number I think about most with this thesis. North American users generate $9.23 in average revenue per user. Rest of world users generate $1.20. That is a 7-to-1 difference. You cannot sustain a premium business long term if your highest value market is shrinking. Management frames this as a deliberate choice. They cut community growth marketing in North America. That may be true, but I'm watching whether those numbers stabilize or keep falling. This is the one metric that would change my thesis. Second issue, advertising pricing. Impression volume grew 17% in Q1, but ad revenue only grew 3%. Why? Because the price per impression fell 12%. More inventory, lower prices. That's a structural supply and demand problem in the ad business. These are real risks. A reasonable person should give them serious weight. But here's what those risks don't change. $609 million in trailing free cash flow, $2.8 billion in cash on the balance sheet, $500 million in buybacks authorized right now. Companies that are genuine value traps don't generate $600 million in cash and then buy their own stock. They issue more shares. They raise dilutive capital at the lows. The board is literally more bullish on this stock than the market is. At $4.71, that is the signal. And that is exactly what drives the options play I'm watching right now. Here's why I'm looking at calls instead of shares. 100 shares of Snap at the current price costs about $475. One call contract, which controls those same 100 shares, costs between $65 and $115, depending on the strike. That is 5 to 6 times the leverage. With one critical difference. The maximum loss is capped at the premium paid. If the stock goes to zero, shares lose everything. Calls lose the premium, that's it. Here are the 4 strikes I'm watching for January 2027. The 450 call, slightly in the money. Estimated premium around $1.10 per share. Break even around $5.60. The $5 call, slightly out of the money. Estimated premium around 90 cents. Break even around $5.90. The $6 call, out of the money. Estimated premium around 75 cents. Break even around $6.75. The $7 call, this was the 7-year support level, now resistance. Estimated premium around 65 cents. Break even around $7.65. If Snap gets back to $7, where it traded for 7 consecutive years, the calls return approximately 122%. Shares return 47%. One important note. Snap reports earnings around August 4th. That's inside the 7-month window. Implied volatility, how expensive options are right now, will spike before earnings and likely drop after. January calls survive through earnings without forced expiration. Right now, implied volatility is elevated from the spec sell-off. I'm not chasing that. I'm using limit orders. Patience on the entry is the entire game here. Don't overpay for the premium. Here's where we are. The market sold Snap because of how a pair of glasses looked. What it missed? The first GAAP profit in company history. $609 million in trailing free cash flow. $500 million in cost savings, not in the numbers yet. a subscription business at $1 billion annualized and growing 87% year over year. The analyst consensus average price target is between $763 and $814. That is 63 to 73% upside from here. The activist with the real stake says $26.37. This is an opportunity of a lifetime, and I am so bullish on this. Before this video, you might have looked at Snap and seen a dying app with bad glasses. Now you see what the numbers actually show. A cash machine at a price the market is treating like a disaster. The board is buying the stock back, the costs are about to get dramatically leaner, the subscription revenue is compounding. And the AR platform has 9 billion daily interactions and 400,000 developers. This is not a hardware story, it's a platform story. Let the numbers do the talking. As always, this is exactly what I'm doing with my money. Do your own research, and if this breakdown helped you see something the market missed, that's exactly why I make these videos.